Welcome back to the channel for another video. Be sure to like and subscribe for more trading content, and let's jump right into it. Today we're going to talk about common trading mistakes, especially when you're starting out and just beginning. We all go through those same roadblocks and have those same pain points. So today I'm just going to identify some of those common trading mistakes and how you can get over them and get through that hump. So these are just some of the things that I discuss into our Market Mentors Discord. Like you can see here, I go through in our various channels. I focus on trading psychology and I focus on trading the NASDAQ. I show things like my analysis of my positions, things that I'm seeing, my process, different teachings I'm doing, show new positions, my winners. I have an Ask and QA channel. You see we have different mentors for stocks, stock options, NASDAQ people that trade as well, funded traders that teach you how to get funded and stay funded. People that do CFDs and Forex. We have different resources and events like live events and different teachings like PDF files and guides like this one on risk management. And we have all kinds of different teaching and resources and value to provide you guys. So check the link in the description for the Market Mentors Discord and website, and stay tuned for that. So just jumping back into it, some of the things that I'll start out with typing this out. Some of the things that you don't want to do whenever you're trading, and even if you're just starting or it's not profitable yet, those common mistakes that people will do is they get in the habits of not journaling. That's the first one. That's a really big one you must do. If you talk to any profitable trader, they will all tell you that you need to journal. It's the most important thing you can probably do to improve outside of the charts. Like, it's the only thing that'll give you an honest assessment of where you are and how you can get better as a trader. So not journaling is a really big common mistake you could do, because you just get caught up in just different things and just start to lose yourself whenever you're trading. So you need to journal. It's really important. It keeps you accountable and helps you get better. Another big mistake you can do is not defining your risk before a trade. If you just enter a trade blindly, it's going to really affect you and affect, of course, your wins and profits and your consistency levels. If you go into a trade and don't know the risk, you just throw a lot into it and you risk a lot of it and it ends up losing. It could really draw your account down. But then if you go into the next trade and still not thinking about it, and you just lower your lot size because you don't want to take a big loss anymore, now ends up winning, and you have a small loss, and that offsets the profit and your equity in your account. So you don't want to go into a trade not defining your risk and not understanding what you could lose before you go into the trade. This is something I talk about in my risk management guide in the Market Mentors Discord as well. I've also got several videos on the channel talking about risk management practices, so be sure to check those out. And let's go to the next tip. Another common mistake is same thing kind of from or not defining the risk, not setting a stop loss. You should understand how much you're going to lose or profit before you take the trade. If you don't set a stop loss, there will be those trades that will literally, you'll enter in, and as soon as you enter in, like 3 seconds later, it'll hit your stop loss. But because you want to limit your losses, you really want to limit those. Yeah, just limit your losses that you take. You want to limit losses and let your take profits be hit. So when you're limiting your losses like this is an efficient way to keep your losses consistent, we'll say. Because if you just hold the trade and you just think it's going to reverse and never reverse, you can really just blow your account and just start losing a lot of profit like that. So it's important always to set a stop loss and just understand where you're going to get out of the market. If it hits a stop loss, then just go to the next trade. And to follow up with that, of course, not setting a take profit. There is going to be those trades that if you just enter in it and you might have stepped away from the chart for a second, went to the bathroom, or you're trying to journal it, and while you're doing it, you forgot to set your take profit, price might just hit your take profit like immediately, or within like 3 to 5 minutes, and then it's going to reverse on you, and you forgot to close up the trade or set the take profit when you first entered it, and it just reverses on you and then hits stop loss because you just didn't take your take profit properly, or you didn't set it at all, and it's going to cost you money just for doing that. It's important to set a stop loss and take profit whenever you first enter the trade. That's just because you want to make sure all the parameters are there and you're understanding what you're going to do and how you're going to get out and understand your exit plan. It's literally happened to me recently. I set a take profit, but I measured the wrong level up because I was on the go, and it bit me in the butt because it hit the take profit that I should have had, but the parameters were a little off, so it ended up reversing. I lost a trade. So it's okay. Just remember, it's a common mistake that we all do. Just got to understand and take your take profit, make sure your parameters are correct, and then execute the trade properly. Another thing is closing out a trade early. This is going to be really critical when you're first starting out and you're first just not profitable, because you don't want to close really a trade early. You want to be able to just accept the risk that you take with every trade. It's either going to hit stop loss or it's going to hit take profit. You just want to let it go and do whatever it's going to do. Unless you have like a rule that is specific to why you would close a trade, like news or market closing or anything like that, you'd want to just let it run and not worry about it. Because when you close a trade early, people often do it out of fear, and they're thinking, okay, I know what's going to happen next. It's going to hit stop loss, or it's going to hit take profit. I'm going to just close it out here, or it's going to consolidate. I'm just going to close it out here. You don't want to close it due to fear. You just want to let it run, and you never know what's going to happen next. So you're just going to need to hold it and just trust your trade in your analysis. The next one will be entering a trade, let's say during high impact news. It's extremely difficult to be able to predict whether the market's going to go up or down during high impact news, or even right before. It's extremely difficult because you don't know how, even if the news comes out and you know it's going to make the asset go bullish, but during that news event, it can literally push down for like 3, 4, 10 seconds, sweep some liquidity, then goes to the upside. But that liquidity could have been your stop loss, or vice versa. You could have just pushed either way. It might push up, then push down, then push back up during the news event, just because it's trying to sweep a lot of liquidity and grab a lot of stop losses. So you do not want to enter news during a high impact, or to enter a trade during high impact news, because it can really affect you, and you can really damage your account doing that. That's even like, I know with funded or prop firms, they won't even let you enter a news like 2 to 5 minutes before, or enter a trade 2 to 5 minutes before high impact news is dropped. So there's a reason why you shouldn't trade during news. You should just let it happen, let the market cool off, then get back in the market. So wait like 30, 15, 45 minutes before you take a next trade after the news is released. At least when you're starting out, that's what I would recommend. Another big mistake goes back to the risk, over leveraging your account on one trade. No one trade should make or break your account. You have to be extremely, extremely experienced and extremely profitable and understand what you're doing to over leverage on like just one trade. It's still, even then, it's just a risk. Every trade is a probability. It all has a probability to lose. You don't know what trade is going to win before you enter. So it could be a winner, it could be a loser. So if you over leverage on that one trade, it could be a loser, and you just might blow your account doing it. Let's say even if you were really confident, had all the confluences, maybe you took 2 losses before, and now you want to get to the next one, you just over leverage to try to compensate for it. That will make you blow your account, because it could just be a loss, and you just don't want to damage your account like that. You want to be consistent and do the same risk parameters each time, so you can just build consistent profit or have consistent losses. At least you're not blowing your account rapidly and just doing inconsistent stuff. Another mistake I'll say is over trading. If you're starting out, you don't want to over trade too much. You want to understand with your journal how many trades you're taking in a week on average, and always try to be around that number. You don't want to just try to take every single trade you're seeing. You want to take those good, clean setups that are within the appropriate time, and just understand what works for you. If you're taking, it depends on your strategy. Like, I personally take around 8 to 15 trades a week. So if I took like 20 trades, I'd be definitely over trading. Or if you're having even a bad day, it is good to always take every valid trade, we'll say. But if you're having a bad day, maybe you're not emotionally or mentally in it, you maybe just stop trading if you've already taken 2 or 3 losses. You don't want to try to take 3 more trades if you're just not emotionally in it, or you're just not in the right state of mind to trade. So just avoid over trading. It really can save you some percentage, or cause you to not have as many losses. Another mistake is trading too many assets whenever you're starting out. Trading too many assets whenever you're starting out. Whenever you trade, or you're first starting to trade, a lot of people will recommend just picking up one instrument, one asset, one symbol to trade. Just pick one thing and then try to master that, and then try to expand if you want. Because it's easier to pick up one asset and just focus on it, hone your skills on it, and understand how to build your own system and how to be a profitable trader. Then you can expand. It's going to be hard if you're first starting out, even just to say with Forex, you're starting out with doing Forex. It's going to be hard to go from AUD, USD, or Euro USD to something like GBP, JBY, or anything like GBP, NZD, because those things move extremely different. They trade during different times. They have a different type of volatility. The candles and patterns look a little different. There's a lot of wicks and things like GBP, JPY, as opposed to like Euro USD, and things are worth different amounts of. The pips are worth different amount of money, and it's all kinds of different things to take into consideration. Just pick one asset or one thing you want to trade. If it's like Forex, or if you want to do the indices, or if you want to do crypto or oil or those type of energies, pick one thing, stay with it, and just focus on it and try to master that and see how you can be profitable. Then you can expand if you would like to. And I will be breaking this video down into 2 parts, so I'll end part 1 here. Be sure to like and subscribe. Check out the Market Mentors Discord and the website and newsletter. The links are in the description. And I'll see you guys in part 2 of the video.